Bitcoin and Ether are both down for the week, even as new economic data out yesterday showed price hikes cooled last month, with annual inflation reaching its lowest level since April of 2021.
Jimmy, you did have the lowest inflation read in a couple of years. But where's your rally?
But I think there's a simple explanation for what's going on in the market. I think the stock market right now just is in fear of a recession.
I think other than regional bank problems, which still aren't gone, we're likely to see rates unchanged through 2023. And that's not currently what the market is pricing in.
Hello, and welcome to today's video. The cryptocurrency markets have been trading higher, fueled by encouraging macro factors and relatively under control inflation. But hold your horses, folks. The surge we're seeing isn't exactly jaw-dropping when it comes to Bitcoin. That begs the question, how will the recent CPI report and the Fed's future decisions impact the future of Bitcoin? What crucial insights should investors be aware of regarding the market? And, most importantly, are there bearish clouds hovering over Bitcoin? Gareth Soloway has been keeping a close eye on the current market situation, and boy does he have some interesting observations to share. In this video, we'll be exploring his views on the current state of the market, particularly his observations on Bitcoin. And if you want to stay up to date with the latest crypto insights, markets, and economy, make sure to hit that subscribe button and the bell icon. All right, are you ready? Let's dive right in.
If you look at some of the meme coins that are going nuts, the speculation that's going on in a lot of the cryptosphere, it does seem like the floodgates are opening. But the price action on Bitcoin, while a little bit of a pop today, it's not enormous. It's taking us back to levels we were just at 2 days ago. And I would dare say that we're still stuck in this trading range of around 30,500 to 27,000. And the other thing I would say is that leading into the potential default for the U.S. government, this is when Bitcoin needs to shine, right? We saw it shine or start to shine with the banking crisis. The potential for a default should be seeing even more price action to the upside. So these are the things I watch as a technical trader, is if we're not getting a bigger move later this month in Bitcoin, I would start to get very, very bearish.
Let's dive into the current market situation. It seems like the floodgates of speculation are opening up, especially in the cryptocurrency sphere. But hold on a second. When we look at Bitcoin's price action, yes, there has been a slight increase after the CPI report. The cryptocurrency markets were trading higher on Monday amid under-control inflation. But it's not exactly a jaw-dropping surge. We're just back to levels that we saw a mere 2 days ago. So, the question is, are we stuck in this trading range between 30,500 and 27,000? But wait, there's more. We can't ignore the potential U.S. government default on the horizon. This is the perfect opportunity for Bitcoin to shine. Right? We've seen its potential during the banking crisis, so we should be expecting even more upward price movement with the risk of default. It's a crucial moment for Bitcoin to prove its strength. Well, according to Gareth Soloway, if we don't witness a more substantial price movement in Bitcoin later this month, his sentiment will take a bearish turn. Let's get into the next clip to hear more from him.
Yeah, so a couple different things, right? And you're right. Here's the chart. We have that trend line that I had in last time we discussed it, right at that 30,500 level. We pierced it briefly a couple times and then came right back in. And we've really gone into this sleeper mode. If you go back to, mid-March, we're still sideways in this 27 to 30,000 range. So to me, this is a level that is still reminiscent of a bear market rally. If we get above, like I said last time, above that 30,500 level, we can start to talk about maybe the low was 15.7. But as of now, I don't see that. And I still see speculation. I mean, in trading markets, including commodities and cryptocurrencies and stocks and everything else, bottoms are made when there's massive amounts of fear, and people are very skeptical initially when something takes off. With Bitcoin, it hasn't been like that. We've seen the speculation in Pepe coin and all these other meme coins. It's a casino. And that's not the sign of a bottom. In addition, I look at what's going on with the government regulation. The government's purposely holding back regulation until they launch their CBDC, which then brings into the question of, is Tether even worthwhile anymore? Is USDC, is that even worthwhile if you have a CBDC that's basically fulfilling that job? Right. Does that have an impact on the cryptocurrencies as well? And then you go to the stock market. And again, I go back to the speculation, the valuations. Apple's trading at a 28 forward PE. That's ludicrous. We have to see speculation come down. I think the stock market comes down, and therefore it brings crypto down too. I actually have a very bearish outlook for the second half of this year. I'm actually looking at a correction of as much as 20% in the S&P 500.
Now, if we take a peek at the chart, there's this trend line around the 30,500 level that's caught Gareth's attention. Since mid-March, we've been stuck in a sideways movement, going back and forth between 27,000 and 30,000. And here's the kicker. Gareth sees shades of a bear market rally at this level. Intriguing, right? But wait, there's more to this story. Gareth believes that if we can push past that elusive 30,500 level, then we can start entertaining the idea that the market low was at 15,700. Sounds promising, doesn't it? However, let's not get ahead of ourselves. As of now, Gareth isn't convinced that we've reached that point just yet. You know what really sets market bottoms apart? Fear and skepticism. Yep, when there's a boatload of those two ingredients, that's when true market bottoms tend to emerge.
If you look at, first of all, the cycles, you have a cycle here where we're due for a corrective move. It's been an elongated bull market. If you go back to 2009, it's all due to Federal Reserve printing of money and low interest rate policy, essentially they were just dropping money left and right, free money and printing money. The government was sending out checks. And then you look at what's happening now. Yes, inflation, we saw the CPI data come in a little bit, but it's not going to get back to 2%. It's just there's too many issues. The first drop from 9.5% to where we are now at 4.9, that's the easy amount. That's the easy drop. That was supply chain. The problem is wages have gone up. And it becomes very sticky. Once those wages go up, it's very hard to get that genie back in the bottle. So you're looking at inflation that probably stays at 3% for multiple years, and that essentially handcuffs the Federal Reserve. The Federal Reserve is going to be very, very careful and wary of printing money or lowering interest rates with inflation, let's say at 3 or 3.5%, because they're going to worry it's going to be a big pop to 15% as the next result. So without printing of money, this market has not been a real market for a long period of time. And when the investing public realizes that the Fed's not going to come to the rescue, that's when you see real panic set in.
So, if we take a closer look at the market, it's clear as day that we're due for a corrective move. I mean, come on. The bull market has been going strong since 2009. But here's the kicker. This extended run is largely thanks to the Federal Reserve's money printing extravaganza and their low interest rate policies. They were practically tossing money around like confetti, and the government even got in on the action by sending out those sweet checks. Talk about a wild ride. Now, let's fast forward to the present moment. Sure, there's been a slight uptick in inflation. We saw that in the CPI data. But, hold your horses, it's not going to hit that sweet spot of 2%. Nope, no chance. There are just way too many challenges standing in the way. For instance, wages have gone up, my friends, and once they start climbing, reversing that trend becomes a real headache.
But the key is that when you see the rescues for the banks, that's not inflationary, right? They're basically making sure the banks aren't blowing up. They're making sure depositors are made whole, but they're not printing money. In fact, you could argue that what's going on with the banks is actually the banks are tightening credit. The banks are being more careful on lending, which is actually working to tighten monetary policy via the banks. So it's interesting, you're right, that they have come to the rescue of banks, but it's actually worked towards tightening versus loosening policy. The retail investor is still in the mindset that the Federal Reserve will come to the rescue. All right. So again, we've been conditioned. It's almost like ringing a bell and the dog comes to the food.
Yeah.
The same thing is true for investors. Investors have been conditioned since 2009 that the Federal Reserve, any sort of big hiccup in the economy, the Fed will come out and print money. And so what we see buy the dip continuing. We see it in crypto, we see it in stocks out there, and that's creating this false sense of security, or what I call complacency. At some point, that kind of mindset of the investor will shift dramatically. So again, to me, that's where the market has a lot of issues in the future over the next 6 to 12 months.
Ah, the retail investor, always hoping for a hero to save the day. We've been conditioned to believe that whenever the economy hits a rough patch, the Federal Reserve will swoop in. But mark my words, once the investing public catches on to the fact that the Federal Reserve won't swoop in to save the day, that's when genuine panic will set in. Sure, the Federal Reserve has stepped in to rescue banks in the past, but as per Gareth Soloway, while they've come to the rescue, they've actually tightened the policy rather than loosening it. According to him, we might be in for some serious trouble in the next 6 to 12 months. Buckle up, folks, because things could get bumpy. So, what are your thoughts on Gareth Soloway's bearish outlook for Bitcoin? Can we see potential market turbulence in the next 6 to 12 months? Let me know your thoughts in the comments below. And don't forget to subscribe to my channel for more updates on crypto and economy. Also, be sure to give a big thumbs up to this video. Thanks for watching, and see you next time. Adios.